Imagine you wake up tomorrow and the price of your morning coffee has doubled, not because of a bad harvest in Colombia, not because of a supply chain problem, but because overnight the financial plumbing that holds the entire global economy together shifted, quietly, irreversibly. Nobody sent you a memo. That is not a hypothetical designed to scare you. That is roughly what economists who study dollar dominance say could happen in a transition away from the US dollar as the world's reserve currency. And right now, for the first time in decades, that conversation is no longer confined to academic journals and fringe economics podcasts. It is happening in government meetings in Beijing, Riyadh, Brussels, and Moscow. So let us actually think through it, not the fear version, not the cheerleading version, the real version. What would actually happen, step by step, if the dollar lost its throne? Start with a simple question. Why does any of this matter to you personally? You have probably never thought about the dollar as a global system. You think of it as money. You earn it, spend it, occasionally worry about not having enough of it. But the dollar is something much stranger than that. It is the language the entire world uses to do business. Oil is priced in dollars. Most international debt is denominated in dollars. When a company in South Korea buys semiconductors from a manufacturer in Taiwan, they often settle that transaction in dollars, even though neither country is the United States. This is what economists call reserve currency status, and the United States has held it since 1944, when the world sat down at a hotel in Bretton Woods, New Hampshire, and essentially agreed to rebuild the global financial system around the American dollar. The logic at the time was straightforward. America had emerged from World War II as the largest economy on Earth, holding roughly 2/3 of the world's gold reserves. The dollar was pegged to gold at a fixed rate. Everyone else pegged their currencies to the dollar. It was clean. It was stable. It made sense. Then, in 1971, Richard Nixon quietly severed the link between the dollar and gold. The dollar was no longer backed by anything tangible. It was backed by something harder to define: trust, and the military, economic, and institutional muscle to enforce that trust. Here is the part that should stop you for a moment. The dollar never lost its reserve status when Nixon made that move. If anything, it deepened it, because by then the world had become so dependent on dollar infrastructure, so woven into dollar-denominated trade and dollar-denominated debt, that switching felt more dangerous than staying. The dollar had become too embedded to fail. That is the system we still live in today, and it comes with a very strange set of consequences. Because the whole world needs dollars, the United States gets to do something no other country on Earth can do. It gets to run enormous trade deficits without immediately paying the price. It gets to borrow cheaply. It gets to print money during crises and watch the world absorb the shock. When the Federal Reserve flooded the system with dollars in 2008 and again in 2020, inflation did not immediately detonate inside America. A lot of that excess dollars quietly spread across the globe, absorbed by countries that needed dollars to function. The French economist Valéry Giscard d'Estaing called this America's exorbitant privilege. That phrase was coined in the 1960s, and it has only become more accurate since. But here's the irony built into the core of that privilege. For the world to have enough dollars to function, America has to keep sending dollars out, which means America has to keep running deficits, which means it keeps importing more than it exports, which hollows out manufacturing, redistributes jobs, and builds up debt. The very thing that gives America its global financial power also slowly erodes parts of its domestic economy. You cannot have the privilege without the structural cost. That tension has been building for 50 years. Now, here's where things get genuinely interesting and a little uncomfortable. A growing number of countries have quietly started asking whether the dollar's dominance still serves their interests.
Russia, after being cut off from the SWIFT banking system in 2022, accelerated its move towards settling trade in alternative currencies. China has been building its own cross-border payment infrastructure for years. The BRICS nations, which now include countries representing nearly half of the world's population, have floated the idea of a shared currency or a common settlement mechanism. Saudi Arabia, which has priced oil exclusively in dollars since the 1970s under the petrodollar agreement, has in recent years quietly discussed accepting yuan for Chinese oil purchases. None of this has toppled the dollar, not even close. The dollar still represents roughly 58% of global foreign exchange reserves. Its nearest competitor, the euro, is at 20%. The yuan is around 2%. But here's what the headline numbers miss. It's not a sudden collapse that poses the real risk. It's a slow erosion, a gradual diversification, a quiet vote of reduced confidence, country by country, transaction by transaction, over years. And if that erosion reaches a tipping point, the effects would arrive all at once. Walk through what that actually looks like. Step 1. Foreign governments begin holding fewer dollars in reserve. They don't dump dollars overnight. That would destroy the value of the reserves they already hold. Instead, they quietly diversify. Buy a little more gold, a few more euros, some yuan-denominated bonds. This is already happening. Central bank gold purchases hit a 50-year high in 2022 and stayed elevated through 2023. Step 2. Dollar demand starts to slip. Fewer countries need as many dollars to conduct trade or hold in reserve. This puts gradual downward pressure on the dollar's value. Step 3. The cost of American borrowing rises. Right now, the U.S. government can borrow at relatively low rates, partly because the entire world wants to hold dollar-denominated assets. If that demand shrinks, the U.S. has to offer higher yields to attract buyers. Higher yields mean higher interest payments on the national debt, which is already sitting at over $34 trillion. Step 4. Import prices rise. A weaker dollar means everything America buys from abroad becomes more expensive. Electronics, clothing, raw materials, components for manufacturing. That cost flows directly to consumers. And step 5, which is the one that tends to catch people off guard, the Federal Reserve loses some of its power. Part of what makes American monetary policy so effective is that the entire world responds to Fed decisions. If the dollar's reach contracts, the Fed's reach contracts with it. America becomes more like a regular country, constrained, responsive to markets, rather than directing them. That's not a catastrophe by itself. Most countries operate that way. But for Americans accustomed to a certain kind of financial insulation, it would feel like losing a superpower they didn't know they had. Now contrast this with the version of the story you sometimes hear from the loudest voices on either extreme. On one end, you have the collapse narrative. Dollar dies, chaos reigns, hyperinflation arrives, stock up on gold and canned goods. This makes for compelling content. It also dramatically oversimplifies how reserve currency transitions work historically. When the British pound lost its reserve status after World War II, Britain didn't collapse. It went through a long, painful, humbling adjustment. It remained a wealthy country. The transition took decades, and it happened at a moment when the clear, credible alternative existed in the form of the dollar. Right now, no alternative exists with anything close to the institutional depth, liquidity, or trust that the dollar commands. The yuan cannot replace the dollar until China opens its capital account and allows free movement of money across its borders. China has shown no serious appetite for doing that, because doing so would mean surrendering control over its own financial system. That's a trade-off Beijing has consistently refused. On the other end, you have the invincibility narrative. The dollar is forever. Nothing can touch it. Relax. This also misreads history. Reserve currencies have come and gone. The Portuguese real, the Spanish dollar, the Dutch guilder, the British pound. Each dominated for a period. Each eventually gave way. not because of a single moment of failure, but because the underlying power that sustained them quietly shifted. The honest answer sits somewhere in the uncomfortable middle. The dollar is not about to collapse, but it's also not immune to history. Zoom out further and the picture gets even more complex. The dollar's dominance is not just an economic fact, it's a geopolitical instrument. When the United States sanctions a country, the mechanism is largely dollar-based.